we're actually pretty optimistic on the Aussie, but of course there are going to be push and pull factors. The RBA rate hikes have of course helped the yield advantage of the Aussie so far. Going forward, we don't think the RBA is going to hike anymore, so the impulse from the rate side is probably not going to be as positive. However, there are other factors that drive the Aussie as well. There is risk sentiment, of course. We have seen US equities or global equities done really well. US, Aussie and Kiwi dollar both tend to be cyclical currencies, so they tend to move up with risk. That's been supportive. And then of course, Australia is a net energy exporter. And as long as energy prices remain elevated, there's going to be a little bit of an impulse there for the Aussie as well. So all in all, that's driving the Aussie. We see the Aussie at 75 into year end. At the same time, of course, we do have a view that the US dollar will also weaken, and that will also then support the Aussie. So with the Middle East conflict, of course, there are increasing risks or concerns that investors and market participants are having that inflation is going to increase. Now, when inflation increases, the action from central banks is most likely to be raising rates. Of course, again, RBA is ahead of the curve amongst the global markets to move on rates already. Other central banks may follow as well if inflation concerns continue to pick up, and that will of course see a little bit of that push and pull for currencies. But at the same time, we do think that the Fed will be unable to out-hawk other central banks, and as a result, we think that the dollar will continue to move lower. At the end of the day, the number one driver for US weakness is US policy uncertainty. Given that market has been moving to headline risk, I don't think there's any limits of that. While there is uncertainty when the Strait of Hormuz will reopen, we do expect oil prices to remain elevated, at the margin higher than where they were pre-conflict. So we're looking at a range of 90 this year and 80 next year, and this is including the event where the Strait of Hormuz opened. Now, what does this mean for currencies? Generally, higher oil prices tend to benefit countries and economies who are exporters of energy. Of course, that includes Australia. We have that LNG side of things. That includes US. US is the largest, one of the largest net energy exporters out there. And so, I think this is going to be reflected in the currencies as well. This is one of the reasons why Aussie has been resilient in the face of such volatility. Now, energy importers such as the European zone, the UK, Japan, generally will likely feel the pressure because the cost of imports for them have gone up. So they have a higher inflationary pressure coming in. And as a result, that will weigh on their currencies.